Hey, Buy Then Build. It is Walker Dybel, and I'm here today with Kyle Howerton, which we'll get to in just a minute. What I want to share with you is that, as most of you know, I invest in the private capital markets. I've been buying businesses for almost 20 years. But what a lot of you don't necessarily know is that I also invest in real estate and a lot of other areas in the private capital markets. And the team in which I'm have invested with the heaviest is AHM, and Kyle's with AHM, and I'm invested with AHM on a couple of different projects. And the thing is I met Kyle and his partners through a mutual friend who is actually a bit of a real estate mogul in the area. And I always wanted to come in, in real estate, sort of at the mid-level. I never wanted to be like swinging hammers on the weekend and, buying, rental properties one-off, because I already had my business and everything that I was doing there. Over time, I've come to learn that in the right opportunities, a lot of the financial returns that are available passively through real estate investing are equal to those in business ownership. And the deal that Kyle and I started talking about, I think in November, was the one that we're going to share with you today. And the thing is that it was so attractive to me. Like the financial returns, the projected financial returns were so attractive to me, and the area of town is so attractive to me, and the leverage that AHM has in terms of this area and the knowledge and the deal that they have. I actually went to Kyle and said, listen, would it be okay if I jumped in as a sponsor on this one and shared it with the Buy Then Build community? Because I think that it's a really good entry-level test to sort of see what the appetite is for people in the Buy Then Build community to co-invest alongside me in some of these deals, okay? So we're going to turn it to Kyle in just a minute. My attorney is making me read this. So pardon the excruciatingly challenge of the legal paragraph here, but I have to read it. This presentation contains forward-looking statements within the meaning of the federal securities laws, which involve risks and uncertainties. These forward-looking statements are not historical facts, but rather are based on current expectations, estimates, and development options about our industry, our beliefs, and certain assumptions. AHM uses words such as anticipate, project, expect, intend, plan, believe, seek, estimate, and variations of these words and similar expressions to identify forward-looking statements. These statements are not guarantees of future performance and are subject to certain risks, uncertainties, and other factors, some of which are beyond AHM's or affiliates' control, are difficult to predict, and could cause actual results to differ materially from those expressed or forecasted in the forward-looking statements. These risks and uncertainties include those described in the investment documents. You should not place undue reliance on these forward-looking statements, which reflect AHM's view only on the date of this presentation. We undertake no obligation to update these statements or release publicly the result of any revision to the forward-looking statements we may make to reflect events or circumstances after the day of this presentation or to reflect the occurrence of unanticipated events. Please also review the risks and disclosures listed on page 67 and 69 of this document, which of course you will get when you get access to the PPM. Listen, I know that was excruciating. Obviously, the same goes for Buy Then Build and everything we do here. But the thing is, again, this is such an interesting opportunity. Kyle, can we just, I want to hand the mic over to you and have you walk through, maybe not the entire 60-slide PPM, but sort of the highlights of what we're talking about. And then before you do that, though, can you just share, sort of the track record that AHM has and why you're focusing on this area and all that kind of stuff?
Yeah, well, Walker, thanks very much for having me join you today. Really excited to see how this goes, and hopefully we'll have some fun while I make this video. But yeah, AHM Group was founded in St. Louis in 2017 between myself and two other business partners. We now have a fourth business partner who has a lot of experience also in the city of St. Louis. And the thing to know about us is that we've been really focused on the city of St. Louis, solely the city of St. Louis. We have also been focused on mixed use projects. So those that have ground floor commercial and the second floors and above are residential. We do own a couple 100% commercial properties, but that's not really our bread and butter. Those are very opportunistic. And what we know is that it's really important to focus on and become an expert in the markets in which we're investing. And so you'll see through the presentation that we have a lot of experience in this specific neighborhood. And again, we only focus on one specific community, and that is St. Louis.
Kyle, I mean, and just to share with everybody, like, I think that the investments that I currently have with AHM, if they might not be my single largest, but like it's right up there, right? Like we're very invested. I have a lot of confidence in your team, and working with you guys for the last couple of years has just been an absolute pleasure for what it's worth. This opportunity that we're talking about, let's just start with who's it for? Accredited, non-accredited, qualified, like who can invest in this deal?
Yeah, so it requires accredited investors only.
Okay.
So that's important to know.
And when are we closing?
At the end of this month, so
At the end
February
of this
28th
month.
or before.
Yeah, yeah. And just to sort of bottom line it up front here, the minimum investment is usually 100, but
Yeah, we talked about this, I guess. Yeah, so we'll accept $50,000 as the minimum.
Yeah, $50,000 minimum, accredited investors only, and then we need commitment and funds by the end of the month so we can close in February 2024. Okay, great. You want to jump into the slide deck and tell the story, as it were?
Yeah, I do. And thanks for joining me in my makeshift office as I move rooms. Let me share my screen. This is our legal disclaimer that Walker just read the cautionary note on forward-looking statements, but please check this page and pages 67 and 69 through 69 out in their entirety. Okay, so these next two slides discuss really the investment vehicle, the structure of the project, the timing, the amount of dollars that are required, and the properties projects themselves. So AHM Group is always the managing member in every project that we undertake. AHM Group is controlled by myself and my three business partners. Members, those who invest in these projects, are 100% passive, so it's important to note that. However, we do like to communicate with everyone, and the thing that we like to remind everybody is that we're in total alignment with our LP investors. So every decision that we're making for ourselves, we take into account the totality of the circumstances in the group that's partnering with us. So today we're talking about really 4 different properties, but it's really 3 improved properties and a parking lot that goes along with one of those properties. So the projects are located in the downtown west neighborhood of the city of St. Louis. And why we currently own about 14 acres there, a little over almost 300 apartment units and a little over 20,000 square feet of commercial space. We're hoping to grow based off of our experience this far. We're really hoping to grow our holdings in the neighborhood and help each of the projects build off of each other and have an example of a rising tide lift all boats. So again, the minimum equity investment is $50,000. We are seeking about $1,250,000 of limited partner investor equity. The structure is, and then the general partnership AHM will invest either $250,000 or $300,000, somewhere in that range, but the minimum will be $250,000.
So Kyle, just for clarification, that makes a maximum of 24 slots at $50,000. Is that right?
That's a good point. I didn't do that math, but that sounds right.
Great, thank you.
And then the actual return structure is.
Hey Kyle, I'm sorry to interrupt. Could you jump to page 18 while you're talking about this? Slide 18. I just really love the outline. And particularly because the sample $100,000 investment graph at the bottom, I just want to be very clear for people interested in buying businesses. Look, it's passive, so there's no cash flow until later years.
Right.
This like IRR of almost 54% over a 5-year period almost completely mirrors what I was able to achieve in one of my early buy then build business acquisitions. And so I just want to land for the audience that like this investment projection is very parallel to the type of things that I look for, and that's why I'm so interested in it. But Kyle, the reason I interrupted you is because as you were talking, I was kind of thinking of this chart on the upper right here.
Oh, sure. Yeah, no, this is great. So and we can touch on all 3 of these. So right now I'm talking about the partnership structure and the return distribution schedule. So 8% preferred return that accrues every day of the year on unreturned capital contributions. And so we would return the 8% preferred return that's accrued whenever it comes time to make distributions. Let me take a step back. So when it comes time to make distributions, the order of distributions will be paying everyone's preferred return current, returning everyone's capital contributions in totality. So 100% of capital contributions returned. And then the general partnership and the limited partnership split the profits 50-50. And this is an example of a sample $100,000 investment. We chose $100,000 because it's a nice, easy, round number to visualize. And so the reason that in years 1, 2, and 3 we are not making any distributions is because this is what's called a value add project. So while it's not a ground up project, these are properties that actually exist today. So there's no ground up development risk, which is a nice benefit. And in terms of a risk adjusted return, we haven't seen anything like this. And really that's driven, I'm going to try to not get too off topic, but that's driven by the fact that this is a non-marketed deal. There's no investment sales broker involved. We have a personal relationship with the seller who is retiring in real estate. He's worked 60 years to build his portfolio, all of which is in St. Louis. And he really wants to make sure that those groups that he's handing select properties off to continue his legacy. So he sought us out and asked if we were interested in taking this on. So for the first 3 years, there's not expected to be a distribution. And that's because we're going to be renovating all of the 139 apartment units. So there's 139 apartment units, about 34,450 square feet of commercial space. And we're going to be renovating all the apartment units, upgrading them, upgrading the rents and tenancy. And then on the commercial space, we're going to continue to turn over each of the commercial spaces. There's about 80% occupancy today in the commercial space. And really over the last year or so, we've seen this neighborhood transition due to several demand factors that we can get into in a little bit. But because of that, there's a lot of service-oriented tenants here now. So restaurants, quick service restaurants, hair salons, barbershops, a nail salon, Pilates studio. Yeah, so this last chart is the sources and uses. You can see the total project cost is about $22,730,000. And then the sources section really details what the whole capitalization, what the capital stack looks like. So we just ran through the distributions and allocations to members. Again, AHM Group is going to be the managing member of the project. And then this runs through fees. So all of the fees that are being charged are market rate fees, some paid to an affiliate of AHM Group and some paid to third parties. But everything is market. The 7th slide, we talk about the overall executive summary. It talks about the 54% IRR and the 7.5 equity multiple, the timeline. It also details each of the properties, Beatrice, Tudor, and 1818. One of the reasons that we really like this project is because we have 3 different properties in different parts of the life cycle. So Beatrice is 36 apartment units and approximately 3,800 square feet of ground floor commercial space. It's a true market rate building in all senses of the word. Tudor is 64 apartment units, 21,000 square feet of commercial space. It was a low-income housing tax credit property, so it was built for those earning or renovated for those earning and leased to those earning 60% of AMI, area median income, or less. And so that happened for the last 15 years. And now that 15-year compliance period has burned off. And so over the next 3 years, that property will transition from solely being leased to low-income tenants to now market rate, which will still be affordable. So those rental rates will still be affordable. Yeah. Well,
so Kyle, is this with market rate rents currently at about 40% discount? Is that how we're able to achieve this IRR of like 54%?
Oh, Walker, that's a great question. So it's everything in totality. So we're making money on the buy, as they say. So we're getting a really steep discount to typical purchase prices. And again, we own almost 300 apartment units just a few blocks away from this across 3 different properties. And this is a very steep discount to what we purchased those properties for. We have other ground up development projects that are in the planned stages. We hope to break ground on those in this neighborhood later this year. And for example, the average cost for an apartment unit to construct ground up is over $300,000 per unit. And you can see that the total cost basis in this project is less than $200,000 a unit.
Thank you.
So it's only about 176,000. And then, yeah, the second component to that is these properties are at a steep discount to market rental rates, and we're going to increase those to just below market is how we've underwritten them, and we hope to exceed that rate. And that stands for both the residential component, the apartment units, and the ground floor commercial. The rest of this slide details what the actual business plan is. It also details the status of LIHTC. So again, Beatrice was full market rate, was never a low income property. Tudor was and is currently transitioning to market rate. And then 1818 Washington, this year, 2024 is the last year of the initial 15-year compliance period. And then it will transition to market rate over a 3-year period. And going back to that slide that we were just on, I think it was slide 18, that's why for the first 3 years, we don't project to be able to distribute any cash flow. However, things can change and we may be able to distribute earlier, but we're not expecting that. Then the next series of slides details the specific business plan for each of the 3 properties. There are a lot of details in these, and this is really a standard business plan for AHM Group. In 2017, whenever AHM Group was founded, we were really focused on ground up developments. And since COVID has hit, there's been a lot of issues with ground up projects, really from a cost and labor availability. So costs have skyrocketed. There's a labor shortage still. Now the material shortage has worked itself out. But during that time, we recognized it was going to be a really challenging environment for the foreseeable future. And by the way, in real estate, foreseeable future is measured in years, not in months or weeks. It's real estate is not a get rich quick scheme. It is definitely a patient person's play. But we transitioned to heavily focusing on value add projects. And so we're following the same value add business plan that we followed in the majority of our about $150 million real estate portfolio, again, solely in the city of St. Louis. So as we hit on before, AHM Group is very focused on the Downtown West submarket. All of the boxes that are highlighted and numbered are holdings that we own today or are in contract to acquire. Those that we're in contract to acquire are shown in red. This is Tudor, the entire block of the 2100 block of Washington, right here. This is the parking lot that is associated with Beatrice, which is number 11. And then 1818 is shown as number 10. This is everything in yellow is either ground up development, again, at a cost in excess of $300,000 per apartment unit. So nearly double what the total cost basis is here. And number 7 is going to be a mass timber high-rise project that at one point was going to be the tallest mass timber high-rise in the world, but now someone in Australia beat us to that. So the whole reason that we're focused on Downtown West in the first place is because of little number 1 right in the bottom left corner. So number 1 is called the 22. That's 42 apartment units and 7,000 square feet of ground floor commercial space. We acquired that property in March of 2021, executed a value add business plan. It went really well. So then we moved on to numbers 2 and 3. These are about 200 apartment units in total. And then we acquired what the next phase in yellow, which are the ground up development projects. And so now we're executing on the red.
Yeah, can I just comment on this? There's a few things I love about this slide. The first thing is that in the lower left, you can see they were during the time of this picture, they were building the St. Louis City Soccer Club stadium right there.
Right.
And that's
which
where
is now complete.
I mean, this is such a cool part of town. And then the thing is that I actually have toured buildings 1, 2, and 3, and very much wanted to invest with you guys at that time, but the timing was off for me, so I couldn't do it. And so I love this part of the city. I know you've got another slide that shows it, in between the other pieces, but like I think that, what this really shows is that you guys are really trying to elevate the whole area in terms of, um, uh, your knowledge and your efforts and your property management. It's really cool.
Yeah, that's right. I mean, the way that we look at things is that information is power, and so the more information you have, you have a competitive advantage. And so, with owning and controlling this amount of real estate in the same geographic location, then we can use that as a competitive advantage. And one of the next slides, we're going to be able to show really what the demand drivers are that encircle this neighborhood. And it wasn't until the MLS stadium was announced and beginning to commence construction that we realized this is really weird. This is a donut hole of activity. We have to focus on this. But I'll come back to that in a minute. So the summary of CapEx is a really good slide because it details by property the business plan for each property from a dollar perspective. And you'll notice that some of the properties have more deferred maintenance than others. Beatrice and 1818 have de minimis deferred maintenance. However, we've budgeted $100,000 just kind of in a slush fund to make sure that we're not caught by surprise upon close of acquisition. Our general contractor has toured all three properties. Our roofers toured all three properties. So we've really gotten ahead of it in terms of trying to ensure that there are no surprises. But as is with anything, there will very likely be a surprise. So we want to budget and account for them. And then you'll also notice that those low-income housing tax credit properties or previous LIHTC properties have the highest dollar amount per unit. It's about $40,000 per unit for 1818 and Tudor. And that's because we're replacing pretty much everything within each of those units: the kitchens, the baths, the flooring, electric and plumbing fixtures. We also have a focus on building security. And so you'll see a budget for both building access controls, unit access controls. We use a company called Latch on all of our properties. It allows tenants to grant guest access from their phone, grant access to themselves, access the building, the parking structure, et cetera, from their phone or key fob or using a code. And then we've planned for some FF&E to make sure that we can procure art and furniture for the common areas of each of these buildings to make them feel like home. And then the lower third of this slide really details the commercial component. So the tenant improvement allowance and the leasing commissions that we need to pay the retail brokers to make sure that we get good attention and can source quality tenants. And then I'd urge you to check out the portfolio summary slide in greater detail, because there's just a lot of information about each of the properties. We've hit on partnership structure and summary returns. And then this is an organizational chart to detail how money is coming in, how the properties are the ownership is structured, who controls what. And as part of, there's a piece of financial engineering that goes into this. So we have loans. First, there's debt and equity, just like a normal operating company, but we have loans to 80% loan to cost. We have the seller contributing a fresh $3 million of preferred equity, new cash into the deal. And then the remaining $1,505,000 approximately is common equity, of which $250,000 comes from the sponsorship, $250,000 to $300,000. And then the remaining part will come from Class A members. Those are the limited partner investors. At the end of the day, AHM Group controls each of the managers. This is an estimated timeline. And again, we're trying to be conservative in every aspect of this project to ensure that we're not taken by surprise by anything, or that any of the members are taken by surprise. January 2028 is our intended exit date to sell all three properties. The investment highlights, we could run through some of these. So this was an off-market transaction. There was no broker involved. That really has driven the low purchase price. Tudor and 1818 were acquiring at a very low basis of $55,000 per apartment unit and $60 per square foot on the commercial space. For the Beatrice, because it's true market rate, we're acquiring that property at approximately $150,000 per apartment unit. That accounts for both the commercial space, the apartment units, and the 39 space parking, surface parking lot at the end of the block. And then even after we invest a substantial amount of money per apartment unit, we are still at a 39% discount to direct sale comps in terms of our total project cost.
That's amazing.
Yeah, the diversified portfolio, again, this is really probably our favorite component of this deal, and equally maybe with the low cost basis, is that we have 139 apartment units spread across 3 properties, 3 different stages of life cycle, 3 different levels of cost basis, and then 17 ground floor commercial bays, of which 15 today are currently occupied. But that results in about 80% of the 34,450 square feet of commercial space being occupied. There's only approximately 1 year left on each of those tenants, on average on the commercial tenant space. What we like about that is that we are already in the process of converting several tenants on a month-to-month basis, and we'll market those spaces for lease. And then whenever we find a qualified tenant that we think is a better fit in terms of the live, work, play neighborhood that we're trying to curate in all of downtown West, that we can then quickly execute on those, but still maintain a certain level of cash flow while we market the spaces for lease. We've never seen this in our career, and one of my business partners, Mikey Anderson, the AHM, and I have arranged debt and equity financing. How we got into the real estate business is we were debt and equity brokers, capital markets advisory, and we've arranged about $5 billion of debt and equity throughout the country on real estate projects. We've never seen a 10% return on cost, especially in a multifamily project. Part of the reason why we're able to achieve that today is because of the high interest rate environment. And when prime is at 8.5%, it's difficult to find accretive debt terms or projects that actually have a return on cost that's greater than the prime rate. And in this instance, we do. What we really like about this project, this portfolio, even with our experience of arranging a substantial amount of debt and equity for commercial real estate across the country, is that even when the prime interest rate in most commercial banks are pricing at 7.5 to 8.5%, we can actually have positive leverage instead of negative leverage. So that just means that every dollar that we're borrowing is still accretive to the equity's cash flow, because the return on cost upon stabilization is in excess of the 8.5%. It's actually approximately 10% on this project. And again, we've never seen that before. Talks about the discount to in-place rents to the market. And then what I also really like, I probably sound like a broken record, but there's just a lot to like about this project, is that we're underwriting stable rents on both the commercial and the residential components to be a discount to what we're achieving across our portfolio today in downtown West for very comparable properties. We've already hit on the active sponsorship within this neighborhood, that we own direct comps to these projects. So we have the information, we know what is reality. We're not getting information from third parties who are misaligned with us. And then we have a lot of experience in the neighborhood. This is an aerial that shows downtown West. This is the MLS stadium that was under construction in the prior, one of the prior slides. And these are the Rothschild portfolio. This is the portfolio that we're talking about today. St. Louis is really an east-west driven demand center. So downtown West, we start at the Mississippi River and then go west along Interstate 64, as the locals call it, Highway 40. Downtown West is located here. What we really like about this location is that it is along the Highway 40 corridor, but it was previously the donut hole of activity in terms of economic activity. We have a $2.5 billion National Geospatial Intelligence Agency headquarters that's being built out. Currently, it will be complete next year. That will add another approximately 6,000 employees, just half a mile north of this portfolio. Wells Fargo Advisors headquarters, national headquarters, that has 5,800 employees, is directly to the west of us by 3 blocks. The 90,000 daytime employees in downtown St. Louis CBD, directly east of us. And then there are entertainment destinations like the MLS Stadium, Union Station, and then 2 other headquarters of regional and national companies just across the MLS Stadium itself. This is more on the employees. So our goal is to have many employees that can actually live in these buildings and walk to work. That would be a win for us, and then curate this live, work, play neighborhood.
So in closing, anyone who knows me and has read Buy Then Build, I think it's chapter 2. I cover sort of my approach to what makes a good investment, right? And it's just to oversimplify it, it's really three things. It's ROI, margin of safety, and upside potential, right? And what I like about this is we've got a good return of investment as investors with the preferred return. We've got rents below market upon acquisition, and it's a value add opportunity, meaning there's an opportunity to go in and increase the return on this investment. The margin of safety is in we're buying below market. Okay. The AHM as a team, in my mind, eliminates execution risk almost as much as possible, right? In terms of, the next point is we own the property management that's even operating with no profit in order to keep all of the profits into the building itself. And then the upside potential is nothing less than the sum is greater than its parts, right? In short, it accumulates into this projected 54% internal rate of return, which is very attractive to the point that Kyle, you didn't know I was going to bring this up, but a couple of days ago you said, I think that like when I die, this will be the best performing project of my career.
Yeah, that's true. I agree with that. Yes, I did say that.
So listen, if you are interested in co-investing along with me and Kyle, actually, go to buythenbuild.com/invest. We'll have a place for you to enter your email address. And then depending on when you see this video, we'll either get your email and be able to communicate with you when we've got the form set up, or it'll give you a link directly to the folder with the PPM, subscription agreement, and all the rest of it. There's 24 slots at the absolute maximum. That's if everybody comes in at 50,000, the minimum. It's going to be first come, first served. And in the ideal timeline is that we'll have commitments, Kyle, on the 14th of February, signed documents by.
Oh,
he'll look, and then we need funds by the 23rd. So it's in there so that we can close on time, right? So again, buythenbuild.com/invest. Kyle, any last words?
No, that's it. We're excited. Thanks for having us.
Super looking forward to this, man. Let's go make some money.
Yeah, let's do it.